yearThe Commission has said that economic growth in the Eurozone is likely to slow slightly this year. The bloc's Winter 2018 Interim Economic Forecast for gross domestic product growth and inflation for all the members of the 28-nation EU said growth in the 19 countries sharing the euro would be 2.3% in 2018 and 2.0% in 2019. However, last month the EU's statistics office Eurostat estimated Eurozone growth was 2.5%. In 2017, the Commission, relying on technical language to explain the downgrade, said this is a result of both stronger cyclical momentum in Europe, where labor markets continue to improve and economic sentiment is particularly high after a stronger-than-expected pickup in global economic activity and trade. The statement said, strong demand, high capacity utilization and supportive financing conditions are set to favor investment over the forecast horizon. yearThe European Union Statistics Office Eurostat estimated that Eurozone growth was 2.5%. Brexit is a positive opportunity to break away from the dead hand of Brussels and take advantage of trading opportunities outside of the moribund Eurozone. Beijing, not Brussels, is where it's at. Neil McKinnon, global macro strategist at VTB Capital, adding inflation could also rise. The statement said, inflation in the euro area reached 1.5% in 2017. It is forecast to remain at 1.5% in 2018 and to increase to 1.6% in 2019. The Commission remain confident that the risks, including Greece's prolonged recovery, the Italian elections and the fragility of the new German coalition, are broadly balanced, admitting that current levels of growth could exceed expectations in the short term because of the upbeat economic sentiment, and the Commission looked to Brexit to explain the economic downturn in the Eurozone. The Commission said downside risks related to the uncertain outcome of the Brexit negotiations remain, as do those associated with geopolitical tensions and a shift towards more inward-looking and protectionist policies. The report assumes unchanged trade relations between Britain and the EU after Britain leaves the bloc in March 2019, but the Commission forecast Britain's economic growth will slow to 1.1% next year from 1.4% this year and 1.8% in 2017. yearThe bloc said that growth in the 19 countries sharing the euro would be 2.3% in 2018, noting that inflation rose sharply in 2017 following the 2016 depreciation of sterling. The Commission said the slowdown has been driven primarily by a decline in private consumption growth due to a squeeze on real disposable income. However, most economists are growing weary of the negative sentiment around the EU's economic predictions around Brexit, and revisions are now being made. The EY Item Club think tank announced earlier this week it has now lifted its UK GDP estimates for 2018 to 1.7%, a massive rise from the 1.4% it predicted last year. The think tank's team of economists have also changed their growth stats for 2017, admitting it was better than they expected at 1.8%. Howard Archer, chief economic advisor to the EY Item Club, said, "The near-term prospects for the UK economy appear brighter, with GDP growth in 2018 being helped by the squeeze on consumers easing as the year progresses." Neil McKinnon, global macro strategist at VTB Capital, supports the claim and slams those who have attempted to undermine the UK economy for political leverage. Mr. McKinnon told Express.co.uk, "The UK economy has not collapsed despite the best efforts of the Project Fear propagandists, indeed, quite the opposite." As the latest economic growth numbers underscored the resilience of the UK economy, Mr. McKinnon is one of a growing number of business leaders who are beginning to see Brexit as an economic opportunity rather than a national disaster. He told Express.co.uk, "Brexit is a positive opportunity to break away from the dead hand of Brussels and take advantage of trading opportunities outside of the moribund Eurozone. Beijing, not Brussels, is where it's at."